Welcome back to the Deep Dive. Today, we're operating as talk tickers, and we are getting into the Williams-Sonoma, that's ticker WSM Q3 earnings call from earlier this week.
And this one was a really interesting case. It's one of those paradoxes you sometimes see.
Paradox how?
Well, on paper, everything looked great. I mean, they beat on earnings, beat on revenue, their performance was strong, and they even raised their full-year guidance.
And yet, the stock dropped. I saw it dipped over 3% right after they announced.
Exactly. And that's the tension. So our mission today is to figure out why. Why did the market basically ignore these incredible operational wins, especially what they're doing with AI, and just fixate on, well, the tariffs and what they mean for Q4?
Okay, so let's start with the good news then, the numbers that should have made the stock pop.
Let's do it. So GAAP diluted EPS came in at $1.96. That beat the consensus of $1.87 pretty handily.
Rare.
Revenue was $1.88 billion, which was a nice solid beat.
But the real story, the one that jumped out at me, was in the comparable sales.
Yes, that's the operational victory right there. Comparable brand revenue, it just completely flipped. It went to positive 4% growth.
And you have to remember, they were negative 2.9% in the same quarter last year. That's a massive swing.
It's a huge inflection.
Yeah.
And it wasn't just, one brand doing all the heavy lifting. All the major brands were positive. It really speaks to some deep operational discipline.
And that discipline, it's showing up on the bottom line, right?
It is. Gross margin expanded 70 basis points, which is very healthy, up to 46.1%. And operating margin hit 17%. That's up 10 basis points, even with what management called substantial tariff headwinds already in the system.
So the company's firing on all cylinders, but you mentioned the market was skeptical, and we saw that too. We flagged some elevated volatility and really unusual put volume.
Right, around that 180 strike.
Yeah, which signals that investors were hedging, maybe positioning for a downturn. They just didn't believe the good news was going to last.
Correct. The market is basically saying, great quarter, but we don't think you can outrun what's coming. And that's the story we need to unpack, the amazing execution versus this huge cost headwind.
All right, let's stick with the operational side for a minute, because this growth is happening even with a soft housing market, which should be a huge problem for a company like Williams-Sonoma.
It should be, absolutely. And what's fascinating is how they're getting that growth. Their physical retail stores ran an incredible positive 8.5% comp.
8.5 in this environment.
I know. Management said it's because they're moving stores out of those tired old malls and into more vibrant lifestyle centers. It improves the experience, and people just end up buying more.
Which is such a contrast to their e-commerce channel. That grew, just under 2%?
1.9%. So that retail number really tells you that the high-end consumer still wants that physical, in-person experience, especially for big-ticket home items.
And it's not just the consumer channels.
No. Don't overlook B2B. That grew 9%. Think corporate gifting, commercial design. It's another way they're shielding themselves from, the ups and downs of the housing market.
Okay, let's get into the brands. The big question for a while has been West Elm. It came in with a positive 3.3% comp, which is a big deal after all its volatility.
A huge win. And what's really important is how they did it. It wasn't through deep discounting or anything like that.
Which would have killed the margin.
Exactly. They said the turnaround is structural, better inventory, focusing on proprietary design. And crucially, this is happening across the whole company, the shift to full price selling.
I remember Pottery Barn was famous for its constant sales.
They're unwinding that. On the call, they specifically credited the full price strategy at Pottery Barn for that 70 basis point expansion in gross margin. They're choosing profit over volume.
Okay, so that's the foundation. But let's talk about the thing I think the market is completely missing. Their use of AI. This is where it gets really interesting.
This is their permanent defense. This isn't some temporary cost-cutting thing. They launched this tool called Olive, an AI shopping assistant for the Williams-Sonoma brand.
That's the flashy front-end part.
Right. But the real savings, the hard numbers, are on the back end, in customer service.
Tell me about those metrics, because they sounded, frankly, unbelievable on the call.
They really are. Get this.
Yeah.
Over 60% of their customer chats are now resolved completely by AI. No human involved.
60%.
And that efficiency gain is just wow. They cut the average handle time for a chat from around 23 minutes down to just 5 minutes.
Wait, hold on. From 23 minutes to 5? That is a quantum leap. But does that speed come at the cost of, customer satisfaction? That could really hurt a premium brand.
That is the perfect question to ask. And they addressed it. They said customer satisfaction scores are actually rising and repeat contacts are down.
So customers prefer it.
It seems so. They prefer the fast, accurate answer from the AI to, waiting in a queue for a human. This is real, hard dollar SG&A savings that sticks around, and almost nobody else in their space is doing this at this level.
Okay, so on one side, you have this operational fortress built on brand strength and AI, and on the other, the fear. Let's pivot to the elephant in the room. The tariff tsunami.
This is it. This is why the stock went down. The tariff situation has gotten so much worse. Management said their incremental tariff rate has more than doubled, from 14% to 29% today.
And that includes some really painful specifics.
Well, yeah. We're talking 20% on goods from China and Vietnam, and a staggering 50% tariff on goods from India.
50%. And India is a huge source for them for textiles, for furniture. That's a direct hit to their cost of goods.
It is a massive hit. Now, they managed it in Q3. They still expanded margins, but that was all about timing. They took advantage of some delayed effective dates. And this is the key part. They aggressively front-loaded their inventory, pulled forward about $30 million worth of products at the lower pre-tariff rates.
So that timing trick that helped them in Q3 is now guaranteed to hurt them in Q4.
100%. Management was very clear on the call. The tariff impact will be, and I'm quoting, substantially larger in the fourth quarter as that more expensive inventory flows through.
And what's the plan to fight it?
They laid out a 6-point mitigation plan. It's everything from, asking vendors for concessions to shifting sourcing to selective price increases.
Let me be skeptical here for a second. How quickly can you really shift your sourcing away from a place like India with that 50% tariff? I mean, isn't that a multi-year project, not a one-quarter fix?
That's the billion-dollar question, and that's what the market is betting against. You're right. Long-term fixes like re-engineering the supply chain take time. The only real short-term levers are getting vendors to eat some cost or raising prices.
And raising prices is risky when you just got your sales momentum back.
Very risky. But here's the kicker. Despite all this, they raised their full-year operating margin guidance. They bumped it up 40 basis points to a range of 17.8 to 18.1%.
So they're confident they can manage it. But does that full-year number kind of mask a really painful Q4?
It absolutely masks the depth of the problem in Q4. Because you have two things hitting at once. First, the tariffs we just talked about. And second, they're comparing against a 53-week year last year.
Ah, the 53rd week. We need to talk about that because the impact was huge.
It was pure profit cushion. That extra week added 510 basis points to Q4 revenue growth last year and 60 basis points to operating margin.
And that cushion is just gone.
It's gone. So they're already starting in a hole because of the calendar. And then you pile on the doubling of the tariff rate on top of that. It makes the Q4 execution incredibly tight.
Which explains why the market didn't want to celebrate the full year raise. They're looking at the high wire act they have to perform in Q4.
Exactly. Can the permanent operational gains, like from AI, overcome these temporary but severe geopolitical cost hits? That's the whole debate.
Let's talk about their balance sheet for a second, because it says a lot about management's confidence. They ended the quarter with $885 million in cash.
And zero debt.
Zero.
Mm-hmm.
This is not a company that's worried about making payroll.
No. And that strength lets them be aggressive with capital returns. They gave back $347 million in Q3 through buybacks and dividends. But the real signal, the board approved a new $1 billion share repurchase authorization.
On top of what was already left.
On top of the $637 million they already had. So you have a management team warning about tariffs while at the same time committing over $1.6 billion to buy back their own stock. That tells you they think it's undervalued.
And they're still optimizing the store portfolio, too. I think you said they've closed about 17% of their stores since 2019.
Right, closing the bad ones and opening good ones. And now they're even talking about growth again. Returning to unit growth for West Elm, testing out retail stores for their new brand Green Row, and brands like Rejuvenation are just crushing it with double-digit comps.
So the message is clear from their side. Tariffs are a problem, but they're a temporary problem within a very strong tech-enabled long-term model.
Right, which brings us to our favorite segment, where we look at all this and try to figure out a way to play it.
This is not financial advice. But if you were going to put on your most outrageous but still plausible hedge fund analyst hat, how would you trade this setup?
I think the trade here is to bet on that structural advantage. You go long Williams-Sonoma and at the same time, you short a basket of their competitors.
The ones that are less vertically integrated.
Exactly. The lower-end furniture guys who just live and die by promotions. The ones who don't have the brand power or the AI efficiency that WSM has.
So the thesis is that the market is just obsessed with the temporary tariff problem.
They're blinded by it. They're missing the permanent moat WSM is building with things like that 5-minute AI chat resolution. That's a real sticky cost advantage. The trade is a bet that those permanent tech advantages will outweigh the temporary tariff costs, allowing them to hit their guidance while their weaker peers get crushed.
A bet on permanent tech over temporary politics.
That's the bet in a nutshell.
Okay, so to wrap this all up, Williams-Sonoma put up a fantastic Q3, great execution, a huge comp inflection, and these really impressive quantifiable savings from their early push into AI.
But investors can't see past the two big hurdles in Q4, the full impact of the higher tariffs and that really tough comparison because they're losing the 53rd week from last year.
So the final thought for you to chew on is about the strategic choice Williams-Sonoma is making right now. In a really weak housing market, they are refusing to chase sales with discounts. Instead, they're doubling down on quality, on service, on tech.
Using this downturn to widen their moat.
Exactly. So the question is, when the housing cycle finally does turn, will this focus on brand equity over short-term volume allow them to capture the lion's share of the market?
That is the multi-billion-dollar question. Thanks for diving in with us.
We'll see you on the next Deep Dive.